there, I'm Alex and welcome to my YouTube channel. Today we're looking at nominal and real interest rates. So I got a quick question before we begin. If you loan out your money at a 50% interest rate, so the borrower will pay back your money plus 50% on top after 1 year, do you gain money? Well, obviously yes. Your money plus 50% after 1 year is more than just your money, right? Wrong! Surprisingly, it depends on the situation, and today we're going to see why this is in a comparison between nominal and real interest rates. That'll be real interesting. So, first off, make sure to check out the first 2 videos of this series for an introduction in commercial banking and interest rates, as well as the AP macro topic 3.2 on the money multiplier and fractional reserve banking. Anyway, back to the video. In economics, when you hear the word nominal, it usually means unchanged or not adjusted for. And the word real is just the opposite. It means adjusted for something, usually inflation. Okay, so the nominal interest rate is just the rate of charge, the one that I've been talking about all throughout this series, mainly in the first video. It's the percentage charge on borrowed money. As I said earlier, nominal interest rates are not adjusted, and so it's nothing more than what the media and banks advertise. Now, the real interest rate is a different story. This is the interest rate adjusted for inflation, or expected inflation. What's inflation? Well, it's basically the time value of money. Simply put, money from years ago had a much higher buying power than money now. A good example is food prices, because you're probably familiar with those. Basically, if we were in 1901, $5 back then would be enough to buy 100 loaves of bread. And that is a lot of bread. Going back to the topic of real interest rates, we first need to know the inflation rate. Inflation rates are basically just a measurement of inflation. The rate is an annual percentage showing or predicting 1 year's inflation. For example, let's say housing prices were $100,000 per house. Let's make it really simple. And then the next year, they increased to $105,000 per house. That would make the inflation rate 5%. Okay, so working out the real interest rate is really simple. You just need to take the nominal interest rate and subtract the inflation rate. As someone saving, knowing your real interest rate can tell you whether you're losing or gaining buying power year over year. If you get this, you'll now understand why banks have to loan out money at an interest rate. Otherwise, they'll lose money from inflation. Let's do a few examples. We're going to take you as a lender, someone who lends money, and say you loan out at 10% interest. So the borrower will pay you your money plus 10% after 1 year. However, at the same time, prices increase by 5%, so your buying power, if you had just held the money, would have gone down by 5%. So that's the inflation rate. With the inflation rate at 5%, your real return would be 5%, because you take your nominal interest rate, which is 10%, and subtract the 5% of the inflation rate. It's pretty simple. Let's do just one more, just to make sure you've got this. As a depositor, say you save some money in the bank with a 2% nominal interest. Now this time, prices inflate by 7%, so your buying power will have gone down by 7% if you had just held the money. Now, you're actually losing money even though you're gaining this 2% nominal interest, because 2% minus 7% equals negative 5%. Hopefully that makes sense. Here's the equation you use to work it out. You may be wondering why I put expected in brackets above the inflation rate. This is because most of the time, when you're trying to work out your expected real interest, you haven't gone through the year yet. You're just estimating it. Because obviously you don't know what prices are going to do over the next year, so the best you can do is just have this expected inflation rate. However, this will mean if for whatever reason there is a real change to this inflation rate, basically unexpected inflation, someone will lose out. If the inflation rate is higher, well, then the lender loses out. If it's lower, it's the borrower. So if we return to my introducing problem where I was talking about if you loan out money at 50%, you should probably be able to see that at an inflation rate of something higher than 50%, let's say 100%, you will actually lose buying power even though you're gaining this 50% return. Though this scenario is pretty unlikely, it can show the difference quite drastically between nominal and real interest rates. In economics, you'll also need to switch this equation around. For example, you'll need to be able to work out the nominal interest rate from the statistics of the other two, or the inflation, or as we just did, the real interest rate. Okay, I've got these questions up for you just so that you can revise what we've learned today. So you're going to have to work out the real interest rate, nominal interest rate, and inflation rate from the other two numbers. Try out these fill-in-the-blank questions, and hopefully it's relatively easy for you. I'll give you a bit of time, but it'll be easy if you just pause it and work it out for yourself. Good luck! Done? Great! Okay, so the first one, we're working out the real interest rate as we did earlier. So we just take the nominal interest rate and minus the inflation rate. So the inflation rate is 2%, so that means prices increase by 2%. And you get a 5% nominal interest rate. So using the equation as above, we take 5%, the nominal interest, and subtract 2%, which is the inflation rate, which gets us 3%. Hopefully you got that. If you didn't, don't worry, but just rewatch my explanation of the process. Okay, the next one's a bit different. We're working out the nominal interest this time, so this equation will help us, but it won't be the equation that we'll use. We have to rejig it a bit. So the inflation rate is 10%, so that means prices increase by 10% over the year. And this time you're losing 6% of your buying power. So this time you're actually adding the inflation plus the real interest rate to get nominal interest rate. So 10% plus negative 6% gets us 4%. So 4% nominal interest rate. Okay, the last one, we're working out the inflation rate. So again, this one will again be different, but it won't be too hard. This time your nominal interest is 8% and your real interest is actually higher at 10%. So you take your nominal interest and minus the real interest rate to get your inflation rate. So 8 minus 10 equals negative 2. So actually during this year, prices dropped by 2%. And that's actually called deflation, and it's basically the opposite of inflation. I'll make a future video on it, but for now, this is all you need to know. Hopefully that makes sense, and that's literally everything for nominal and real interest rates that you need for an economics class. I'll leave up one more question at the end of the video, but it won't be on screen for too long, so make sure to pause the video and work it out from there. Thanks for watching, and make sure to watch out for the next and final video on the manipulation of interest rates, which is monetary policy. I'll see you next time.